Hello, good day, and welcome to this daily educational video. I'm your host, Robert Blackwell, here at Forex.Academy. Before we begin this daily educational video, as always, do be aware of the risks involved trading these financial markets, and please have a look at the following disclaimer. Now, the particular webinar content of this daily educational video, we'll be discussing inflation, and we have seen some very big inflation news this week with the Bank of England changing some of its policy views there as a result to rising inflation. So, first of all, let us ask the question, well, what is inflation? Inflation is generally the rise in the cost of goods and services in a domestic economy. It is measured by the producer price index and, of course, the consumer price index, the CPI there. Why is it so important? Well, let's look at a few important points. The cost of living in a country or region, that's effectively going to tailor into the fact that inflation is rising or decreasing. And obviously, if it is increasing at a very, very high or strong rate, well, the cost of living is going to be very difficult in that particular region. It's also going to relate into the currency and how hyperinflation, which we've seen in Weimar, Germany, how that effectively crippled the economy. So it's a very important dominant factor in actually controlling the money supply of a currency. It defines the monetary policy of a central bank. So to take one example, the Bank of England, the Federal Reserve there, and of course the ECB there in Europe, the European Central Bank, they have a policy target of 2% inflation. And that's on an annual basis. Now, what does that mean? Well, it means their target is really to focus in on keeping inflation sustainable at 2% growth per year. Obviously, as there is an increasing supply of money, obviously these central banks increase and that supply by printing money through the financial markets and swapping debt with good debt and bad debt. That increase in money supply, it effectively means there's more money chasing the same amount of natural resources or goods in an economy, and of course that's going to lead into a rising amount of currency in terms of flowing around these economies and a rising amount in inflation. So in turn, then the monetary policy of a central bank is to keep that in check. So just to keep it rising but steady at 2% per annum. It is the key factor in pricing interest rates, and that is simply a factor of the aforementioned monetary policy there. Really, the key tool of a central bank is manipulation of the central bank policy interest rate. So perhaps if, let us use an example that inflation is rising at 3% or 4%, that's very high as a rate of inflation. The central bank will use that tool, that interest rate, perhaps increase interest rates to make investment less or more attractive in combat of the actual rising or decreasing level of inflation in an economy. It's a key factor in pricing bonds and currency. So as we view, obviously, interest rates as a level of debt or a level of interest you can make off a loan or debt, in terms of from one party to another. Bonds are effectively the same thing. So to use your own currency or your own account there, your own bank account, if you have a deposit account where a bank is offering you a very high interest rate, of course you're going to find that more attractive in leaving your money in the bank. The bank will pay a level of percentage for your deposit. Actually, that interest rate affects all these really the themes of investing or loaning money throughout the financial markets. So one example is actually the bond markets, that effectively, if it's a government or a corporate bond, it's effectively over a duration of 2, 5, or 10 years, and it's going to provide a level of income in terms and reflected on the level of interest rates in an economy. And obviously currency valuation is very, very important when we discuss inflation. So let's look at that in a little more detail. Inflation on currency. Well, the first thing that I would like to point out is there is a time value of money. So if we have the cost of goods and services and effectively the cost of our money increasing or decreasing over time, well, there's going to be a relation to our currency on inflation. So effectively, we lose what we call the purchasing power value from our money. Really, as inflation increases over time, we can't buy as many goods for that. So really, there's too much chasing too few goods. And that's the point with inflation. Obviously, if there's a very high level of inflation of an economy, things become much more expensive. And there's going to be a sort of disconnect between the capital or the cash that we have to buy those goods, and there's going to be certain factors that will have to really come into repricing certain economic assets so that they'll be more affordable to us. The value of money is then eroded. So if we have potentially a capital amount of 100,000 euros in a bank account, and inflation is 2 or 3% per year, yet the deposit or interest rate on our deposit from the bank is giving us 1% interest, but effectively we're not actually making any profit from depositing or keeping the deposit in that bank account for that specific period of time. Effectively, inflation is eroding the value of our money over the long term, and effectively you're better off trading or putting those assets or that capital in something a little more risky to actually outperform inflation. In terms of the domestic economy, it loses competitiveness, and this is why it's such an effect on actually trading forex pairs. So forex currencies, obviously, they are some of the most volatile, but some of the most interactive markets that we can trade. Why is inflation so huge and actually looking to price currencies against one currency to another? Well, if we think of inflation again to describe it as the level or rising level of goods and services in a domestic economy, let's say we have a high level of inflation at 5%. Well, those goods and services are going to be very, very expensive to other economies across the world. So because they're so expensive, they lose appeal, they lose attractiveness, so that potentially other companies that want to trade in that nation will be retracted from doing so. They might not be able to afford investing in some of these assets given inflation is continuing to increase. It actually loses its competitiveness, and investment or the investment community will go elsewhere for better investment opportunities. So that's going to have an effect on the currency. There's not going to be there's going to be a decreasing level of trade flow or cash flowing into that currency, and really that means a decrease in demand of the currency. And obviously we know that demand and supply really factor in terms of pricing all of these financial assets. So we'll see a real shift or contraction of demand in the domestic currency, and that will lead it to a decrease in price over the long term. So inflation has a really effective, a real impact on many of these global assets we trade across the financial markets. So that was a quick discussion on inflation in our economies. Thank you very much for joining us, and we'll see you next time. Bye for now.